You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Welcome back, everybody. Welcome back, Hamish Hodder. Now that's my new way of introducing the podcast. Welcome back, Hamish Hodder. How are you going? Because I remember I commented on the alliteration. How you doing down in Melbourne?
Yeah, we're doing okay. We're still in lockdown.
Lockdown city.
Yeah. I think we ticked over 200 days in lockdown since the start of the pandemic. So big milestone.
Congratulations.
Thank you. Expecting my medal in the mail any day now. So.
Well, after all of this time where I've been up on my high horse saying Canberra's not gone into any lockdowns, boom, guess what happens? I pushed it one step too far and now we're adding 20 COVID cases a day now. So we're in lockdown, and on this podcast today, we have our good friend Tom from Investing with Tom, and he's also in lockdown. How you doing over there, Tom?
Yeah, well, good considering the circumstances. I think New Zealand's been pretty much the same as Canberra, kind of talking crap to all the other areas of Australia, and now we're back in lockdown as well. So Here we are.
Sounds about right. So how many COVID cases are you guys having over there? And is the whole country's in lockdown, or?
Yeah, whole country's in lockdown.
Right.
We went into lockdown just with one case in Auckland. I think we're a couple of days into it now recording this, and I think we're up to 10 or 15 cases, something like that.
A day or total?
That is total over 2 or 3 days.
Oh, right. Okay. So you guys are still doing better than even Canberra. So actually, that's one thing. New Zealand it seems like New Zealand has handled the COVID crisis pretty well. I mean, Australia was doing pretty well. But yeah, New Zealand's just been, put the walls up, nice ocean around, 6 million people, just one case, lock it down. They seem to have managed it pretty well. But anyway, welcome back to the COVID podcast, everybody.
Always have to give an update about what's going on in COVID. Oh, this week we had one new restriction, by the way. We now have a curfew, so...
You have a curfew?
Fun. Yeah, we have an 8 p.m. curfew, so you have to get inside or else they kick you inside. They don't do that, but...
They give you a fine, probably. There you go. Yeah, that'd be so bizarre. I haven't had a curfew yet, but probably only a matter of time. We'll see how we go. Anyway, talking about investing, which is what we're all here for, it's a big week this week because we get all the 13F filings. Well, all the 13F filings from the really big investors, right? Because, if they're going to shift the market with what they have in their 13F, then they're going to report it as late as possible. So all the big name investors, they push their 13Fs as late as possible. And that was the 16th or the 16th, 17th or something. And it's now past that date. So we've got a lot to talk about. So this should be a pretty jam-packed podcast, and it'll be good to ask a few questions at Tom as well. So let's get stuck into it, eh?
For sure. Today's episode is sponsored by Sharesight, which is an application that you can use to track the performance of your stock portfolio. So basically, it will allow you to bring in all of your trades from your broker, either automatically or manually, and it will track all of the different types of gains. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you just hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 10 different reports, or I think it's actually 12 reports now, that can be used to track your performance as well as at tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan, and track up to 10 holdings for as long as you want. Or you can use that link to get 4 months off a yearly subscription if you sign up to a more premium plan for premium features. And once again, thanks to everyone who has used that link and is supporting the podcast.
Indeed. Thank you very much. All right, team, let's get stuck into it. Tom, I'm interested. So me and Hamish, we always talk about 13Fs and how we use them, who we follow. I'm interested, who do you follow? Who do you like to look at when it comes to 13F filings, and how do you typically use the information within?
Yeah, I think 13Fs are great. I'm a big fan of them. So, I mean, I don't think I follow a lot of people who you guys wouldn't be following. So, obviously, Warren Buffett. Right. I follow Charlie Munger sort of through the Daily Journal Corporation. Those would probably be the big two. Then also Mohnish Pabrai, Guy Spier. Phil Town doesn't file a 13F per se, but there are some SEC filings out that allow us to kind of see what he's up to. And then each quarter, I also try and sort of find one or two new ones, which are sort of interesting. So, the Seth Klarmans or Michael Burrys of the world, or this quarter, I actually stumbled across Nick Sleep's 13F, and I didn't even realize he filed a 13F. So that was a nice find as well.
Yeah. Tell me more about Nick Sleep, because to be honest, I need to do more research on him, and I just haven't so far, because I've heard in a lot of Mohnish Pabrai interviews recently, he keeps bringing up Nick Sleep and this idea of long-term compounders and how he's been changing his strategy. How did you come across Nick Sleep, and kind of who is he? And I understand Hamish was saying he's got a lot of Buffett-style shareholder letters that are kind of got good information in. I'm interested if you know much about him and his backstory. I'd be interested to hear.
Yeah, I basically came across Nick Sleep the same way. So Nick Sleep is an investor out of the UK. He ran a fund called Nomad from the early 2000s till I think 2014. And Nick and his partner Zach are a chapter in a book that's just come out recently, Richer, Wiser, Happier, which Mohnish Pabrai was actually chapter 1 of, I think. So yeah, pretty interesting story. They're really hard to find info on. And in that book, William Green, who's the author, actually said that, Mohnish Pabrai was telling me about this guy called Nick Sleep and said it'd be great if you could interview Nick Sleep, but he'll never talk to you. He's very private. And somehow he managed to kind of talk him into it, which was great. But as far as investment, kind of his investment record and style and all that sort of thing, it's very impressive. Over that 14-year roughly time period of his fund, I think they did 21% a year. They started investing like very, what I'd probably describe as deep value style. So, to the point where him and his partner were going to Zimbabwe and buying cement companies during hyperinflation at 10% of replacement cost or something insane. So he transitioned from that to, basically buying these long-term compounders. And it got to the point where his entire fund, more or less, was basically invested in Amazon, Costco, and Berkshire Hathaway. And, Nick Sleep eventually got to the point where he's writing these letters to his investors, which are great if anyone has a chance to read those. I'm only a couple of years in, but those are really good. And he was sort of like writing these letters and updating his investors and saying, well, we haven't really done anything this year. We still own Amazon, Costco, and Berkshire Hathaway, and we think that's great value add. And and at a certain point, actually some of the UK regulators were concerned about how concentrated the Nomad, fund's portfolio was. And by that point, they'd made more money than they could ever imagine. So they basically just decided to wrap up the fund and say, here's your money back, just go invest in these 3 stocks. That's all we were going to do anyway. Did the same thing personally. And I don't know, he bought Amazon at like, I forget exactly. It's, I think something like $30 per share. He bought his first Amazon shares in that ballpark.
Whoa.
And he was in Costco, I think in 2002 or 3, somewhere in that range as well. So just absolute home runs by sitting on his backside, more or less.
Yeah, he's an insane investor. And I think I completely agree. The Nomad letters to read, I think, are up there probably with Berkshire's letters in terms of the value you can get out of those letters. I mean, even just one particular thing that he spoke about a lot, which was like how he valued Costco. The level of detail that he goes into in explaining why he invested in Costco is something I've never seen an investor do. Even Buffett doesn't go to the level of detail. Like, he basically explained his entire thesis on Costco, starting with how they were doing very well in, I think it was Washington State, and that his valuation was basically extrapolating that success based on population density and the number of warehouses they had across the US. Like, he was very detailed in explaining this is how they can get to this revenue number, or this is why they will grow it. I think it was like 12 or 13% long term for 10, 15 years was his long projection. So really, really valuable, I think, if you're really into valuation and understanding how you should be thinking about projecting businesses forward. So really, really interesting guy.
And so he had this fund and he essentially held 3 stocks. He was getting a little bit more heat because regulators were like, wow, this is concentrated. So he shuts it down. First of all, he shuts it down, says to everybody, look, just invest in these 3 stocks yourself. How many fund managers would actually do that? They'd be like, no, trust me, you need to keep your money invested with us, and they take their percentage. And or is he just like, look, we're just going to shut the fund. You guys just invest in these stocks your own and you'll do fine. But Nick Sleep, he's still publishing 13F filings. Is that right? So he's done something in the meantime.
Yeah, it's really interesting. Like I just assumed that, you know, the 13F days for Nick Sleep are kind of gone since he's wrapped up the fund. But I just kind of stumbled across a tweet the other day as I was kind of scrolling through Twitter, and someone said, oh yeah, Nick Sleep hasn't done much again as per usual. Look at his latest 13F. And I was like, what? there's something there. And yeah, turns out he runs a charity with, you know, over the $100 million threshold for 13F filings. So yeah, that was really interesting find just in the last week or so for me.
So, and in his 13F, does he still just hold Amazon, Costco? What was it, Berkshire?
Yeah, I was going to say, I'll give you 3 guesses as to what's in there. It's still Amazon, Costco, and Berkshire.
So literally, he started a charity and he's still holding the same stocks. There's nothing more elaborate than that.
Yeah, and in the book that I was just talking about earlier, Rich Wiser Happier, it tells the story. So Nick Sleep wrapped up the fund in, I think it was 2014. I think the interviews for the book were done in this particular kind of part of the story is like 2018, 2019. At that point, Amazon was something like 70% of his net worth. And he was kind of like, okay, maybe this is getting a little much. And I think he sold half of it personally in 2018 and he bought into a UK company called Asos, which I know, Hamish, we were talking about that a little bit a couple of weeks ago. I don't know if you've had a chance to look into that yet.
Yeah, I've been looking into Asos a little bit, not since we spoke, but prior to that, I had looked into them a little bit because, I mean, my initial impression was, well, if the other businesses he's invested into, and this is also a retail business online, but, you know, I guess Amazon is also an online retailer, but it was a very similar business to some of his other major investments. So I was wondering, does this business have this scaled economies shared competitive advantage, which is this kind of business characteristic, the way that a business model really that Nick Sleep was very good at identifying in Costco and Amazon. So I was kind of coming at it from that perspective, like, can I kind of see a similar pattern in this business to Amazon and Costco? And I could see something to some extent. I certainly don't think I've finished doing my analysis on Asos, but I mean, certainly you can see that over time they've done things like reduce the cost, reduce the price per unit on their site over time, and that's somewhat a characteristic of businesses that are returning some of the scale efficiencies to customers. But yeah, I'm not too sure about that one just yet. I think it's about twice as expensive as it was when Nick Sleep probably invested a significant amount into it. And the business is significantly larger than it was then, but it's significantly more expensive as well. So yeah, I'll have to keep going on that one. But we don't get, I think we were talking about this just before the podcast, we don't get to see his Asos investment publicly, right? We don't have any data on that over time.
Yeah, not that I know of. I mean, the 13Fs are obviously just US businesses and Asos is in the UK, but there are other filings from different countries. Like if people buy 5% of a Japanese company, for example, we see it, and that's how we found out about Buffett and Berkshire buying those Japanese trading companies a year back or whenever that was. So I think we might see it if he bought enough of the shares outstanding, like a big enough percentage of the company, but that hasn't been triggered as far as I can tell.
Right. Okay. It's a super interesting buy for him because he clearly sees similarities and it's kind of in his circle of competence and in his zone of similar businesses to what he's done in the past. It's interesting though, because you think about a Costco works because of that scaled economies thing where, as you get bigger and you touch more people and you can bring the cost down and, pass those savings on and it makes you even more popular. I don't know. I feel, and I haven't looked into this, but this is kind of like my thought is that would that specifically work for fashion? Because so much of the revenue, the amount that you charge for a garment is in the brand. It's kind of like luxury car sales. It's like a Ferrari could, if they wanted to, lower the price of a Ferrari, but there's something about the fact that it costs $1 million. Do you see what I'm saying? It's like if you're offering garments, that you perceive to be, high quality and brand and designer brand or whatever it is, you want to, I'd almost be hesitant to lower prices to a point where, you don't end up feeling like a Target or a Kmart. You said, you've passed on all these savings and now this really expensive looking designer dress, you're selling it for like $10.
Yeah. I mean,
I don't know. I feel like that has the potential to almost like backfire. Same with like cosmetic brands. If you start lowering your price a lot, then it's just like, oh, this is just the cheap brand of makeup,
Yeah, I mean, there may be some truth to that, but I mean, they are wholesale buying massive global brands. So, I mean, if they are able to buy them in higher quantity, then there could be some room for them to be able to sell them on at a lower price. But I mean, there's also other ways that they can go about sharing efficiencies with customers. So things like reducing the cost of shipping and reducing the time on shipping is something that Amazon has obsessively focused on, right? That doesn't come through on the price, but if you have Amazon Prime in the US, I mean, in a lot of places you can do same day delivery. And that's a massive improvement in customer experience. And Amazon is obsessed with lowering prices as well, but that's kind of another way that they can go about it. Another thing that Asos does and Costco really does this as well, is that they do really good returns. So in Asos's case, because they're an online retailer, they actually eat the cost of the return shipping. So basically it encourages this habit of buying where you're happy, you're completely comfortable buying things, even if you haven't tried them on, their shoes or their clothes that you haven't tried on. And you end up getting this culture around online shopping that is, instead of you just buy what you want, you buy 10 items, you try them all on and you send back 3. Or you like them all, and if the product is really good relative to the price you paid, you're just going to end up keeping them. And it's a way for them to generate massive volume, massive frequency in purchases, while just basically having less profit margin because they just eat the cost of the returns that will inevitably come back. But
right, okay, that makes more sense. And I guess I didn't realize that they're just distributing other people's brands. So I guess my argument doesn't probably hold up in that sense. If they had their own brand, I thought they were like their own brand or something.
They do have their own brand. So to some extent, that could certainly apply.
Right,
but the vast majority of products they sell on Asos are from global brands.
Yeah, which makes sense. So in that case, then the scaled economies model works really well because then it's like, oh my gosh, I can get this designer clothing that costs X amount elsewhere else, but I can get it cheaper on Asos. Right, I see. I see. Very interesting. Very interesting. Tom, do you have any other insights on Asos? I really, as you can tell, don't really know much about it. Or should we move on to our next topic?
I probably know about the same amount as you, Brandon, so I think we should move on.
All right, no worries. Well, let's keep talking. Do you guys want to keep talking 13Fs?
Yeah, for sure. Yeah, who else have we got? Give us some. Let's start some big ones.
Yeah, let's start with the big daddy, the big boy himself,
the buff dog.
Big Daddy Buffett, the buff dog. I love that. Honestly, I'll run us through the 13F for Warren Buffett. I wish it was a little bit more interesting this quarter. I mean, we've had some good quarters in the past from Buffett. There was obviously the quarter where he sold out of all the airlines. There was a quarter where he bought like 8 or 10 different business, like new buyers, and that was really interesting. But this quarter is just, he just hasn't done much. Interestingly, he's sitting on about 140 something billion dollars of cash. The share portfolio is up to a value of about 300. What was it? Oh, I've got it written down. 300 and something billion. $308 billion. So he's sitting in like 30% cash at the moment, which that's been the case over the last little while. He's just obviously struggling to sink a lot of that money that he wants to sink into the market because the stock prices across the board are so high. So overall with Buffett, there was one new buy, which was called Organon, but I figured out that was just a spin-off from Merck, and then shareholders of Organon, shareholders of Merck got 1/10 of an Organon share for every Merck share. So I think that's just because he's a shareholder in Merck. So that's boring. In terms of additions, the only reasonable addition was a 21% increase to his Kroger position. And Hamish, have you looked into Kroger in the past?
Yeah, I didn't fancy them too much, to be honest. It was a little while ago, so I'm gonna pull up the summary of my analysis just so that I can refresh my mind. But I think I like looking at companies that have really low levels of debt, if not nothing. And I think Kroger had quite a significant amount of long-term debt. So for that, it was kind of just an immediate, not super interested. And they're a pretty slow grower at this point. They're growing at 4 or 5%. In 2019, they grew at 0.3%. So they're very much just a slow burn business. And maybe that's what Buffett is looking for. They pay a significant dividend, but I'm kind of looking for businesses that might be on the cusp of, have grown well in the past with a proven track record and are on the cusp of producing significant growth in the future. And I think Kroger's probably not that business, considering their current position in the US.
Right. Okay. So he added 21% to Kroger, and he also added to RH and Aon, but really nothing significant there. In terms of what he reduced in the pharmaceuticals. So he actually sold half of his Merck position, and then only sold 15% in Bristol Myers Squibb and 10% in AbbVie. Do you guys know? I'm like, honestly, I can't really talk too much. I know basically nothing about pharmaceuticals, but I was surprised that he bought 4 pharmaceuticals in Q3 2020. He bought Merck, Bristol Myers Squibb, AbbVie, and Pfizer, and he bought them all at the same time. So it's like, okay, does he just want, is he trying to do some sort of coronavirus vaccine play or something random? But that theory got thrown out the window because then in the next quarter, he ditched Pfizer. And he's been selling down now 50% in Merck and selling down 15% Bristol Myers Squibb, 10% in AbbVie. So I don't really know what the go is here. I guess he just wanted Berkshire to have some broad exposure to pharmaceuticals, and now maybe as time has gone on, he's decided, yeah, I like these ones a little bit more than those ones. But honestly, I don't really have a great insight as to what he's trying to do here. Do you guys have any ideas?
Well, when it first popped up, it actually caught my attention a little bit. I mean, it caught everyone's attention. It was kind of in the news everywhere. But the reason it caught my attention is because a year or two back, I went basically back to I think it's mid-90s, something like that. You can go back and watch all the old Berkshire Hathaway annual meetings, like the shareholder meetings, and go through all the Q&As and stuff. And I recalled a question and a comment that, or a question Buffett got in a comment he made, kind of in response to it about the pharmaceuticals. And I think this was in the late 90s. And he said, in the early 90s, all the pharmaceuticals kind of looked relatively cheap, but he kind of didn't know enough about each company to make a big bet on one of them. And he was sort of saying, maybe I should have just done a basket bet. I probably would have done that if I was back in that situation again. And I was like, 20 years later, now he gets the chance to do it. And I thought that's kind of what he might be doing. Maybe he just thought the sector was kind of cheap generally, but to see him back out of it relatively quickly is kind of strange. I really don't know what he's doing there, to be honest.
Yeah. And I think all 4 of those were fairly low PE. I mean, obviously we don't look into the PEs too much, but I mean, just generally they didn't look like they were super expensive. I mean, not that Buffett would ever buy anything that's super expensive, but that makes more sense because that is exactly what it did look like. It looked like at the time, you buy 4 pharmaceutical companies that all kind of do similar stuff and you buy them all at the same time. Definitely not a vaccine play because he just sold Pfizer as soon as he bought it pretty much. But yeah, interesting. Definitely Berkshire would then want the diversified exposure to pharmaceuticals. But I don't really get why he's halving Merck. I guess one thing that we might expect from someone like Warren Buffett is that in the next 13F, we might see him continue to reduce Merck because maybe he just wants to get rid of it. But honestly, I have no idea. Hamish, any insights on that?
No, not really. It's really hard to assess why you think someone's doing a move if you have no idea about the industry. And I think pharmaceuticals is just an area I know like nothing. Like I couldn't even give you a shred of info on the pharmaceutical market. Whereas at least there might be like retail businesses that I haven't looked into, but I might understand the context of what's going on in the industry or something like that. That is certainly not true for me with pharmaceuticals. So,
all right, well, let's move on out of that then. So on top of the pharmaceuticals, he also reduced 10% in General Motors. Now, he's continuing to sell down this position, but he is selling it slowly. He sold 10% of his position in Q4 2020, then 8% in Q1 2021, and 10% in now Q2. So it slipped in this quarter. It slipped from his 10th largest holding to his 12th largest holding. To be honest, I'm not a huge fan of General Motors as a business. I think it's a fairly weak business. I'm surprised that Warren Buffett holds it, to be honest. And their metrics have kind of just been drifting slowly down over the past like 5 years or so. So I don't know if you guys have anything why Buffett is selling slowly. Does he want to still hold it? Does he still see value in it in the long term? Or because it seems weird that he's kind of just consistently selling down roughly 10% quarter after quarter.
Yeah, well, I mean, I had an investment in Fiat Chrysler, which is now merged with another business to become a company called Stellantis. So I know this industry reasonably well, and Buffett was
Please enlighten me.
he was sort of slowly buying it for a long time as well. Like for probably 2 or 3 years,
right.
Every quarter he was just kind of chipping away at it a little bit. And I mean, auto businesses suck generally. Like they are hugely capital intensive. You've got like unionized workforces. If your competitor, it's like one of those industries where your dumbest competitor sets the price to a large extent, and you have like a lot of what you call operating leverage. So like, in good times you make a small, nice little profit margin, but in bad times you can lose like 5 years of earnings in 3 months, So it's a rough business. And I see the stock has about doubled in the last year or so. So maybe he's just capturing some of that gain, but hard to say.
Right. Okay.
Yeah. Very difficult business to assess long term, I think, because, I mean, if any business goes through cyclical periods where they're losing a ton of money, there's just so much uncertainty associated with that. Most of these businesses that are cyclical carry debt because they require it. It's a very capital intensive business, and it's very difficult to assess what short-term economic conditions are going to look like. And auto businesses are notorious for going bankrupt during weak economic activity. So not a great business. I also don't. Yeah, I mean, I'm not really sure about trimming as well in terms of what Buffett is doing there. At certain times, he said that he does trim positions. At other times, he said that he doesn't trim positions, that if it doesn't meet his principles, he'll just sell out of it completely immediately. So I don't know. Who knows?
And it's not like he needs the cash to buy other stuff. Like he's got a pile of it sitting there. So who knows?
Yeah, that's actually one thing I was going to bring up, is that, just to finish this off quickly, the last thing I wanted to say is that he sold out of Axalta Coating Systems, Biogen, and Liberty Global. But overall, you're right. He's got so much cash sitting around. He hasn't really done too much in the quarter. And I think that kind of tells us that from this quarter, firstly, he's very comfortable with like the top 5 holdings because he just, it's just not touching him. But it also shows me definitely that he is really struggling to find places to put his money, because he said in the past he wants to find whatever he said, the elephant-sized acquisition. He wants to get some of that money in. But, the fact that he's not really sinking any money into new positions, and he's not even sinking a substantial amount of money into increasing positions he's already got in businesses he already likes, to me, that just says that he is really struggling to find anything that would value add to Berkshire Hathaway at the current price that it is. Do you think that's fair? I'm interested to your thoughts on that kind of statement as well.
Well, the biggest move Buffett made last quarter actually doesn't show up on a 13F. He bought back, as far as I can tell, about...
What was that?
He bought back about $6 billion of his own stock. So that's what he's finding at the moment, and that's about the extent of what he's finding.
Yeah, that's right. I totally forgot about the share buybacks, but yeah, he bought a stack back of Berkshire.
Yeah.
But yeah, I don't know. I'm interested to see, like, when, honestly, at this point, I'm like, man, to see Warren Buffett sink a big chunk of money into the market that's not maybe a Berkshire buyback, I feel like we're going to have to see a pretty mighty sell-off or a pretty, like, decent sized recession for him to even get a sniff at anything that seems like it's decent value.
Yeah, well, I mean, given the size of how much cash he needs to put to work, there's just such a limited options now for what investments he can make. And I think for a really long time, people have kind of used Buffett's cash percentage or position as an indication of what theirs should be. I just don't think that's true anymore. I think that, I mean, I don't know how many it was, but it was such a small number of businesses that he could invest, say, $50 billion, which would reflect like a 10% investment based on the size of Berkshire. Approximately that much, right? But there's only a handful of businesses that are big enough to do that and not be buying 50% of the company or 100% of the company. Whereas us as little fish, there's obviously way more businesses we can invest a very small amount of money in. So there could very well be a lot of businesses that are undervalued right now, but Buffett just can't buy them given the way he wants to invest. So there's that to keep in mind, I think, as well. When we look at Buffett's cash position, it's kind of normal to see that it's at that size. It's very difficult to find undervalued businesses when there's only 8 total businesses or 12 total businesses he can actually put money into.
How's that for a first world problem, though? Sorry, guys. I'm finding it so hard. I've got too much money. I try to buy things, but it's just not impactful. I've just got too much.
Yeah, cries himself to sleep every night.
Yeah. Oh, dear. Oh, my gosh. Steps down as CEO. Investors outcry because he hasn't been deploying the hundreds of billions of dollars that he's made as investors over the past, what, 60 years? Man, that's crazy. Yeah, like almost 60 years. Wow, geez, that's a long time. Anyway, that's Warren Buffett's 13F, the big daddy-o. Should we talk about Michael Burry? You guys interested in Michael Burry? Or should we talk about Guy Spier? Do you want to talk about Guy Spier first, Tom?
Yeah, for sure. I read Guy Spier's book a couple of years ago, and since then I've been a pretty big fan of him. Yeah. So yeah, Guy Spier is the master of doing nothing. I would say he's not quite on Nick Sleep's level, but he's not too far away. So
sits in Zurich and does nothing all day.
Yeah, pretty much. Maybe meditates and does a bit of yoga or something, I think. Yeah. But yeah, I was interested to see that. To see that Guy Spier made 3 changes to the portfolio this quarter. So there was one stock he sold out of completely, which was Wells Fargo, previously 3.1% of the portfolio, and sold 100% of it. And then he added 2 stocks. So he joined the long list of investors now in Alibaba. He puts, where is it, about 5% of the portfolio into Alibaba. And the one that probably surprised me the most was actually about a 2% bet on the Daily Journal Corporation, which is obviously Charlie Munger's, or where we can see a 13F from a portfolio that Charlie Munger manages as well.
Interesting. This we've got to talk about Alibaba, I guess, because this has just been
kidding.
The absolute. I mean, we already have been talking about it over the past few podcasts.
Yeah,
we'll talk. Hamish, you were talking about it when you were talking about Chinese regulation of big tech, but my gosh, Alibaba is just the flavor of the month. Or the flavor of the last year or so in terms of value investors, or maybe the last 3 or 6 months. So who we got now? We got Charlie Munger, we got Mohnish Pabrai, Guy Spier. Actually, Tom, myself and Hamish, was it on air or off air? I can't remember. Last week, we were discussing what percentage chance, because we hadn't got Buffett's 13F yet. We were like, what's the chances that Buffett's bought Alibaba? And I think we both said probably pretty unlikely, but I think we both gave it like a 20-ish percent chance.
Yeah.
And I think because we said, well, Charlie Munger's bought into it. I mean, they're pretty good buds. So, I mean, from your perspective, I understand you've done a fair bit of research so far on Alibaba, and you've obviously been following the super investors that have sunk money into Alibaba. Why is it the flavor of the last couple of months? Is it because there's no other opportunities? Is it a really good business? What do you think's drawing them to the stock?
Yeah, I think seeing Charlie Munger go into it in the Daily Journal Corporation, because he was sort of the first one. I think there's sort of a flood of super investors have kind of followed that. And yeah, I mean, upon doing a bit of digging, it is a really good business. Like it's grown revenue at something like 50% a year compounded for the last decade. It's got a whole suite of e-commerce businesses in China, and actually in Southeast Asia and some other places as well. It's got Ant Financial, which owns Alipay, which is like, I think their user number basically matches the number of people in China that have a connection to the internet. So you get a 1/3 ownership stake in that as well.
Wow.
And then you've got this relatively small in the grand scheme of Alibaba at the moment, but you've got a very fast growing cloud business, again, growing at like 50% a year or something. So you get all of that, and then you sort of run some discounted cash flows or look at some, basic valuation metrics on Alibaba, and relative to their growth, and of course they're not going to grow at 50% a year forever because they're already huge, but even if they can grow at 10 or 15% a year, maybe, like by my maths, it looks pretty cheap. That's not a stock tip or anything, but that's kind of where I've arrived. Yeah. I guess the giant red flag hovering over it, and the reason it's down so much recently, is just political risk, basically. And is Alibaba going to get delisted? Technically, if you buy BABA on the New York Stock Exchange, you're buying into an entity in the Cayman Islands. So do you even actually own Alibaba? Like that's not a new thing, but it kind of has been brought into the limelight a lot more recently. So there's kind of lots of red flags, I guess, or lots of things kind of hovering over Alibaba, which scares many people away. But I guess you've got the value investors who have been listening to Buffett say, buy fear and sell greed for the last 50 years, and maybe they think this is their opportunity. So
yeah, it's an interesting one. Hamish, do you have any thoughts on Alibaba? Not really in your zone. I mean,
yeah, not really. I mean, if you just at a very basic level look at its valuation, you can see that, I mean, given if it grows at, mid-teens, that it will probably do extremely well for you. But then the question is, do I understand the business well enough to know whether mid-teens is reasonable? And beyond that, are there other uncertainties such as government intervention that just might completely shatter that ability to grow? And for me, there's just so many question marks. So
yeah, fair.
It's not, I've said this before, and I have to say it every time I talk about a business that I don't want to invest in.
You're shorting it.
It doesn't mean I think, I'm not shorting it, okay? Off air, Tom, okay? Not on air.
Oh, sorry.
Gosh. Yeah.
No,
we have our on-air opinions and our off-air opinion. Jeez, that would be so dodgy.
That would be horrible.
There probably are people that run podcasts like that, though, to be honest. But no, it is interesting. And to be honest, this is probably not the right way to think about it. But the thing that kind of gives me a little bit of comfort about the whole it's an ADR, the whole Cayman Islands way of investing through into Alibaba. The only thing that gives me a little bit of comfort there is that that's the way that all of the big US value investors are investing in it, right? They are buying BABA, the ADR. Is that right, Tom?
I mean, that's all we can see. So, I mean, there's a chance they're also buying it on the Hong Kong Stock Exchange, and we wouldn't see that.
True,
Who knows?
yeah.
But yeah, there's a long list of people buying the US listed version of Alibaba. That's for sure.
Right.
They might be buying the US listed version, shorting the US listed version for the same amount. We can't see the shorts, and then buying it.
Oh my gosh, this is elaborate. This is elaborate. They've all figured it out. They've gotten together. And then they're like, hey, so Charlie's going to start us, right? So Charlie, you make your invest. Then Mohnish is like, then I'll come in second. Guys like, I'll come in third. We're going to pump the hell out of this stock. And then just when all of our value buddies are on board, we're out.
The greatest pump and dump scheme of all time.
The pump's not working very well from what I could see. So it's not playing out.
It's going south and it just keeps going south. Yeah. But I guess that'll... assuming that they haven't maxed out their positions, I imagine all of these investors are going to continue to buy in. They've already started and it's just getting a better deal. So I think the next 13F will be telling, especially now that I think it's dropped down to the 170 range, if I'm not mistaken.
Yeah. Well,
172. And when Charlie started buying, I think it was in the low 200s.
I think about 220s, 230 maybe.
Yeah.
Right. But it's getting cheaper and cheaper. So I would be interested to see what kind of buy numbers are on Alibaba in the Q3 13Fs.
Yeah.
That will be very interesting.
Well, even this quarter we saw, because Mohnish Pabrai entered into Alibaba in the previous quarter, not the last one. In this quarter we saw, I think he increased his position by 50%, if I'm not mistaken. So that's already kind of an example of what you're talking about, where you've already seen one big investor upping their investment as it's come down. So yeah, we may continue to see that from a few others going into the next quarter. Such a long time to wait, 3 months. Wish they had to do it every month
day
or something. Just a live counter. What?
Kathy Wood.
Well, that's what it is.
Isn't that a Kathy Wood move?
What's that?
To publish your trades every day.
Yeah, that's it.
Does she do that?
Yeah.
Interesting approach.
I did not know that. There you go. And for those that want to learn more about Alibaba as a company, Tom, what's the book that you read? And do you want to maybe take us through, because I'm yet to read it, but I really do want to read it, what that book was and maybe what are some of the takeaways that you got out of the book?
Yeah, sure. So that book you're referring to is called, what is it called? Alibaba, the House that Jack Ma Built. I think it's by Duncan Clark from memory. So Duncan Clark's former investment banker, has lived in China for about 20 years. And it's actually funny, I was listening to Duncan Clark give a talk as part of his book tour when it first came out. And he was actually offered options, in Alibaba as part of his investment banking work in like 1999 and turned them down. And he's like, man, these would have been worth, I forget the number, but it was like $50 million or something. And he's like, so I hope the book sells very well to make up for that. But yeah, that's a really good book. It kind of goes through the story of Alibaba. Well, Jack Ma initially, actually, and kind of his upbringing and a bit of his early business failures, actually, and kind of like discovering the internet and going through that kind of part of his life. And then, it goes into the business of Alibaba, talks through something they call the Iron Triangle, which is what I would describe as their moat. So it's kind of this combination of their e-commerce businesses, their logistics advantages, and then basically Alipay, their kind of financial arm, all sort of working in harmony to allow them to, grow as well as they have grown. So that was one of the key takeaways, I'd say. Definitely learned a lot about Jack Ma, and also just learned about a lot of the kind of stupidity that that people that are not living in China but want to get Chinese exposure. Like, for example, there's a really good story in that book of eBay trying to come into China and just completely screwing it up like you would not believe.
Right.
And it just goes to show, I think, the fact that like all the American e-commerce businesses basically have no chance in China was my takeaway from that. Like, I mean, one of Alibaba's major e-commerce platforms is called Tmall, and like Amazon have a store on Tmall. That's kind of the point we're at with Amazon trying to compete in China. So
right.
Really good book. Definitely recommend it.
The same thing actually rings true with Alipay and their payments business, because Visa and MasterCard they dominate everywhere, but they're actually banned in China. All payments are processed by a government-run body in China. So what people in China have done as a result of that is they use things like Alipay, which basically operates as a digital wallet service. They're not actually processing or facilitating transactions between banks. But that's like another example of where their payments business is completely dominant in China, and Visa and MasterCard actually cannot operate in China, which gives them a massive advantage in that market, and then they can maybe use that advantage to spread it elsewhere as well.
Is a big advantage, I guess, for business in China when the Chinese government's kind of like, no. Everybody else stay out, and we'll just keep bringing up the Chinese businesses within. I mean, it is an advantage. But yeah, I think it's interesting that a company like eBay just doesn't comes into China and just flunks. I think. I don't know, this is just my theory, but I feel like when businesses try and expand, I mean, a lot of the companies we look at, they start in the US and then they get good traction in the US and they're like, oh, where's the next logical place? Oh, where there's also like a good economy and a heap of people, let's go to China. But I just feel like from what I have just, I guess, learned is that there's just a massive cultural difference between the US and China, and just a lot of, businesses which work well with the way of life in the United States just don't sync up with the way life works in China. And maybe that's politically, maybe it's just like, cultural differences, but I don't know. I just feel like there's definitely, and an example that I remember is like watching a documentary on Disney theme parks when they opened. Oh, where was it? It was Disneyland was it Shanghai? Is there a Disneyland in Shanghai? I can't remember.
There's one in Hong Kong, I think.
Hong Kong, maybe Hong Kong. Yeah, Hong Kong, I think that might be the case. But when they went there, they had to be so careful with the way that because they had this approach. This is what Disneyland looks like in the US, and then they were trying to take Disneyland to I can't remember. I think let's just say it was Hong Kong, and they were like, "Hang on, does this actually work culturally for where we are?" So they had to be very careful about bringing the elements of Disneyland, which made Disneyland so successful in the US, but also not doing it so much that it's just like, well, this is just some American thing that nobody actually wants to take part in. But anyway, that's like a little anecdote that just popped into my brain. But I don't know, guys. Should we? Do you feel like we should wrap up our 13F chat, because we do actually have a lot of questions? I think Hamish, did you put out the request for if anybody had any questions to ask? Well, to any of us, I guess, but we'll chuck them to Tom because it's just easy. We can just ask him questions, kick our feet up, and then Tom, you can just finish off the podcast for us, really. But
well, we have so many that you probably could, and we still would run over time. So thanks to everyone who's thanks everyone who asked questions. I only made the post not that long ago, and there's a lot of questions here. So thanks everyone for who did ask questions. Where should we start in terms
wherever
of
you like, Hamish?
Here's a question. Here's an interesting question. I would love to hear his thoughts about his upbringing and relationship with money growing up. Thanks.
Oh,
interesting. I don't know if I've ever talked too much about this, but I grew up. I grew up in a town called Matamata, which is sort of in the middle of the North Island of New Zealand, if anyone is familiar with that. Grew up in town. When I was about 12 or 13, we actually moved onto a dairy farm and also moved to Northland, which, as you can probably guess, is the uppermost region of the North Island of New Zealand. Grew up on a farm, which was good fun. Like, got to ride motorbikes and learn to drive tractors when you're like 13 and all that fun stuff. So that was good fun. I actually went on to go to school in Auckland. So I went to a boarding school actually called Dilworth School in Auckland, which is probably a story for another day, but that was probably near the best thing that's ever happened to me. Like I got every student that goes to that school is on 100% scholarship for all your education and boarding and everything. So that was a great opportunity. Went on to then study a degree in agricultural science down in the South Island of New Zealand. So sort of merged like the maths and science stuff that I kind of liked at school with farming, which I kind of grew up with. And I've been working in the agricultural industry actually, so completely unrelated to investing for the last 4 or 5 years now. So that's kind of my upbringing. I guess in terms of relationships with money, I really don't know if I had anything particularly out of the ordinary with growing up with money. Like I'm not from a super wealthy family. I'm not from a super poor family, but yeah, I guess I saw like my parents constantly working very hard, and that probably inspires a bit of work ethic from my end, but maybe also a bit of inspiration to try and grow something outside of my day job so I don't have to work if I don't want to. But I think that's probably been, I don't know. It's an interesting topic kind of talking about money growing up. That's kind of where I've got to with it though, I think.
Yeah.
How'd you get specifically stuck into stock market investing? Was it just natural when you decided you wanted to try and compound money, or is it something you got taught about? Or
Yeah, that was, this is going to sound like a really dumb story, but it's literally how it happened, so I'll tell it anyway. So
we love it.
I was like a few months into my first job after leaving university and studying ag science, and I like jumped in my car. I was walking back to my car one day or something, and after work, and was just doing some basic maths on like what I get paid right now in my first job, how much of that I'm saving, and if I work from now until I'm 65, like how much money will I have in the end? And the number was really underwhelming. So I was like, there's some, like I'm reasonably good at maths, but I'm sure I'm missing something here, like something's not adding up, and kind of connected the dots that was investing. So I guess at the time I think I had a few $1,000s saved up, so property wasn't an option, and property is like the main investment vehicle for a lot of New Zealanders. I think the culture is probably pretty similar in Australia, but maybe even more extreme in New Zealand, where people are pretty much only care about property, I would say. I wasn't in a position to do that, and then kind of stumbled across the share market, and then went down the rabbit hole of Warren Buffett. Then I think I found Pabrai and Phil Town, and the rest is history. I don't know, history is still playing out, but that's kind of the rabbit hole I went down and found all this stuff.
Interesting. We got a question here. How's Tom's house hunting going?
Yeah.
I don't know. Are you looking for a house at the moment,
I am
Tom?
looking for a house at the moment. Yeah, it's...
Me too.
It's 3 of us.
Yeah.
all 3 of us.
This is why prices keep going up, because everyone's looking for a house at the same time and none are out there. So, it's been interesting. Done a few weekends, open homes and all that. Now I actually had a crack at bidding on one a couple of weeks ago, which we didn't win, but that was a interesting experience. Yeah, a bit nerve-wracking. I don't know. I think it's one of those things you kind of just keep looking, and there's a lot of competition out there at the moment for a lot of homes. Prices are high. I kind of hope interest rates stay low if we do buy something. But it's tough. There's not a lot of new stuff kind of coming onto the market, and prices seem to not really be slowing down anytime soon. So
I wanted to ask you that question specifically to see if your situation is the same as what we've got here in Australia, and it sounds exactly the same.
I don't know the exact stats in Australia, but I've looked a bit in the US, and housing prices are up like everywhere pretty much, but New Zealand has the most extreme numbers I've seen. I think property prices were up something like 25% in the last 12 months. Pretty crazy leaps upward.
Yeah. And I mean, it makes sense that housing prices are at all-time highs. I mean, they're at all-time accessibility on a monthly mortgage payment basis. So, I mean, it makes perfect sense. Pretty straightforward mechanic, but it does make it difficult. Particularly in certain markets. I think like Sydney and Melbourne, at least I know of, that are just crazy.
Yeah, and it's interesting because like I think it's the same in Australia, but New Zealand doesn't have these nice like 30-year fixed rate mortgages like you can get access to in the US. So it really is quite a big bet on interest rates staying low if you really pay up for one of these places.
Yeah, absolutely. I think I think I've seen a 10-year fixed product, but I think once you start getting out that long, I don't think it's a very good deal anymore. But I think generally, and I'm no property expert, but I think generally in Australia, 2, 3, or 5 year fixed is generally what people sign up for. But yeah, that's what because I heard I was listening to some property video and someone's like, let's imagine this 30-year fixed mortgage. I was like, whoa, 30-year fixed? It's like, what hang on. So the interest rates at the moment on various loans are like 2-3%. If I could fix 2 or 3% for 30 years, but then I was just like, yep, nope, that doesn't exist. Not here at least. And even if you could fix it for that long, I'm sure the interest rate wouldn't be quite that low, but
yeah, insane.
Interesting. Hamish, have you found another question? Do you want to do one more or two more?
I'll just read the rest of that question first. And how's Brandon's Tesla, aka Chick Magnet, going?
I thought I got away unscathed. That's why I wanted to ask that question. So the Chick Magnet. No, it's good. I mean, I really like it. This is the thing with electric cars. Yes, you do pay up. Yes, they are expensive. But since I actually bought it, ongoing costs, I mean, yeah, it's an expensive car, granted, so insurance costs are a little bit higher. But in terms of maintenance, haven't had to do anything. I actually, just the other day, for the first time, I had to do my first bit of maintenance. I had to fill up my window washer fluid.
Wow.
Yeah.
Tragedy. My car started making a weird noise, and I'm just hoping it'll go away. I don't know.
Yeah, just kick it a couple of times.
Yeah. Usually I just ignore it and then it'll go away in a few months.
I think I heard a mechanic tell me that one time.
Yeah.
Oh dear. Hey, all right. Is there another one, Hamish? Should we do one or two more?
God, I'm hunting here for a good question.
There's plenty.
All right, here's one about something we were talking about with Nick Sleep before. Hamish and Tom, you've mentioned that you've been learning about Nick Sleep and the scaled economies shared business model, which I'm also learning about. The model seems to be very obvious for retailers and e-commerce like Amazon, Costco, and Walmart. Outside of retail, what are the types of businesses or industries could partake in the scaled economies shared business model? That's a good question. Do you have any thoughts on that, Tom?
This is something I've been trying to figure out because I feel like if I can figure this out, I'll get very rich, but I haven't quite got the answer yet. But I don't know. I actually was kind of thinking about it this might sound like a bit of a strange one, but I was sort of thinking about it with commodities, actually. Like, is there some low-cost commodity producer that can just constantly undercut people? And sure, maybe your profits are lumpier than a Costco or an Amazon, but maybe that's one. I know people like Phil Town, for example, have had long-time investments in and out of businesses like CF Industries, which is a low-cost kind of producer of nitrogen fertilizer. So I don't know. I haven't got any obvious ones that have come to mind, but man, investingwithtom@gmail.com if anyone thinks of any.
Point a Mohnish there.
There we go.
Yeah.
I guess that does make sense though. Commodities. I mean, at the end of the day, I guess technically with commodities you can be producing slightly different variations, but let's just say for shits and gigs that it's all the same thing. Like if you're a lithium miner, you're trying to mine lithium, right? So if there's something about your business, I mean, I guess they're all playing they're all competing with each other to sell the same stuff. So you're right. If you have something about your extraction techniques or your refining techniques or whatever that makes it lower cost than, the next guy along. I mean, for example, the only one that I can think of, which is not really a commodity in itself, but it just popped into my head, is Tesla. With the new battery cell that they're making. And I guess the commodity in this sense, in my mind, is the battery cell. And for example, they are using these dry coat electrode technologies or whatever, which means that they can eliminate these huge electrode drying ovens, which take just a humongous amount of energy and take up a whole bunch of space in these cell manufacturing plants. And in Tesla's new battery solution, they just don't need it. And that has a significant impact on the cost per kilowatt hour of battery that they can produce. So that's like one example. But yeah, that's really interesting. And I hadn't thought about that. But now that you've said it, it really springs to mind. Yes, commodities is a very applicable one for the scaled economies model.
Yeah, I'm just kind of thinking through it now. Like with CF Industries specifically, I think they have facilities in certain locations where they can get low cost natural gas, but I just wonder if they struggle to make that model travel. That's where maybe that idea falls over.
Right.
I'm not sure. I'd have to look more into it, but I'd love to figure this question out.
Should we do? Sorry, Hamish, you continue.
Go on. I had nothing more to say. It's all good.
Oh, okay, no worries. I was just going to see if we could pick out one more question. Let's see. Oh, this will be an interesting one. Ask Tom what his best and worst investments have been, and specifically what he learnt from them. Always like asking this question. You always learn it a bucket load.
Yeah. Worst investment is Fiat Chrysler. That's the only stock I've ever had a locked in a permanent loss of capital on. What I learned from that, I mentioned it before, operational leverage. Like you do okay in good times and it looks really nice because you're buying something at 4 times earnings or whatever. But then when you lose like 3 years of those earnings in 6 months, it doesn't work so well. So that's kind of what I learned from that.
Right.
I actually, interestingly, I think I sold about 2/3 of my position when kind of COVID started happening. And I could see the annualized losses just being enormous, like getting close to the market cap kind of thing. I was like, man, I'm not going to hang on to this. And they recovered a lot quicker than I ever anticipated. And me holding on to that little like 1/3 of my stake actually recouped a lot of those losses. So I think the permanent loss was like, because they paid some special dividends and stuff as well. My permanent loss was like 15% maybe, which in the grand scheme of things, I don't think is bad at all.
Not bad.
Good.
Yeah, a mistake that's probably larger than that would be passing on a stock I mentioned last time I was on this podcast, which was Corporate Travel Management. That would have been my best investment ever, but
Hamish is like,
I was like, yeah, Hamish.
I told you that.
I was because I wasn't really familiar with the business. Beside, I think hearing you guys talk about a short report maybe a few weeks before the chaos happened, and I think it had, like, I know, Hamish, I think you said you bought it, like, you bottom ticked it, just, like, obviously, luck. Bit of skill, bit of luck. We'll call it skill, Hamish.
A lot of luck.
I think I was studying it on that same day. Like, I was looking at it at $5 a share, might have dropped into the 4s. And by the time I was on this podcast, like 2 weeks later, it was 10 and I was like, missed it. And now it's 20 or more, right? So that's probably the biggest one. Biggest mistake. Best investment, hopefully still to come. I've been buying a little bit of Alibaba recently, so hopefully that'll turn out to be the best one. Probably something like Thor Industries would be up there for me. I'm just naming Hamish stocks at the moment, but that's probably
cloning me now.
Yeah, I'm the shameless cloner of the shameless cloner. So there you go.
Shameless cloner of the shameless cloner of the shameless cloner of the shameless cloner. It's just a chain of cloners.
It's like how people get nervous about interest rates when the Federal Reserve starts talking about having the meeting about rising interest rates. So
we're thinking about
exactly.
rates is what they were saying.
That's what they said, isn't it?
It's ridiculous at this point. Yeah.
Oh, very good. Oh, thanks for the insight, Tom. And yeah, hopefully best investments for all of us are still to come. But I think we'll probably wrap it up around there. Thanks very much, Tom, for your time today. Thanks for coming on. We always like talking to you. It's always a really good. We always seem to go very in depth when we talk with you, and you always bring so much value and a lot of your insights to the table. So we really appreciate having you on.
I appreciate you guys inviting me on. I'm an avid listener of the podcast myself, so it's good to make dreams come true and get a seat at the table.
And is this the second or third time we've had you on the podcast? I can't even remember.
Second, I think. Yeah.
Second,
I think, but I know it was the second.
There's the cross-pollination. I mean, we've been on your podcast, you've been on it. It's just, we do a lot of content. You've been on my channel, I've been, So All right. Well, thanks. Yeah, thanks again for joining us. Where can people find you? You're on YouTube, Investing with Tom. You got your podcast. Yep. I'll let you.
No, that was great. You're doing a little ad for me. I've got Investing with Tom on YouTube is the main channel. I also got a podcast by the same name, the Investing with Tom podcast. I'm nowhere near as consistent as the Young Investors podcast, unfortunately, but I'm fairly consistent on YouTube. I also actually have a second YouTube channel called Punch Card Investing, which is a collaboration between myself and 4 other YouTube sort of value investors, and we do weekly live streams every Saturday my time here in New Zealand, but depending where you are in the world, that may vary. We actually have 5 different time zones with the 5 different people on that live stream, so that's a bit gnarly, but if you ever want to come and ask me questions live or anything like that, that would be the place to go.
Nice. Awesome. Oh, thank you very much, Tom. Thanks for coming on. It's good to talk to you, my friend. And thanks always, Hamish, for joining us as well.
No worries.
Good to pick your brain. And thanks, guys, very much for tuning in to the episode. And with that said, we'll wrap things up. Thanks always to Sharesight for sponsoring. And we'll see you guys next week.
See ya.